Hi traders, Lance Beggs here from yourtradingcoach.com. Today we're going to finish our introduction to candlestick analysis. That's right, the candle patterns are coming up in the very next video, but first we have to cover some very important information, basic foundational information that must be understood before you try to identify the patterns on your chart. That is, the stages of a candlestick pattern. Let's check it out. Stage 1. A prerequisite for any candlestick pattern is that price must be in a trend. Now that can be an uptrend or a downtrend, it doesn't matter, but in this case a sideways trend does not count. So price must be trending up or down. Stage 2. We then get the candlestick pattern. Don't ever fall into the novice trap of blindly trading every occurrence of the candlestick pattern without first confirming the price was trending. Okay, so first we must have a trend and then the candlestick pattern develops. Stage 3, then we look for confirmation. As we discuss the patterns in coming videos, we'll discuss the level of confirmation required. For aggressive traders, you may not be looking for much confirmation before you enter the market. We'll discuss possible entry points, such as in the example showing here of a top reversal pattern. An aggressive trader may be looking for price to trade below the midpoint of the pattern. Around here, looking at the cursor on the screen now. For conservative traders who may want a bit more confirmation, we'll discuss possible entry points for you as well, such as perhaps price trading below the low point of the pattern, or even further below the low of the breakout candle. That's coming up in future videos. For now, just understand that you need the trend, then the pattern, and then confirmation. Without all three stages, you do not trade. Yes, sometimes a candlestick pattern leads to brilliant profits without a trend. Understand though that is just the probabilities being against you on this one. As a professional trader, you're not looking for certainty. You're looking for a low risk and or high probability trades that provide you with a probabilistic edge. And if you want to get that through candlesticks, then you want to have the three stages in place. A trend, then the pattern, and then confirmation of movement in the required direction. Let's look at a couple of possible scenarios. The first one should be familiar because it's basically the same as the last slide. An uptrend, followed by a bearish reversal pattern, perhaps a shooting star or a bearish engulfing pattern or dark cloud cover or harami or whatever, and then followed by confirmation. This is a signal to enter short, not a guarantee though of the market moving lower, but an indication of a higher probability of a short-term lower move. You still need to appropriately manage and exit this trade, but in terms of entry, this one is a good signal. Here's another scenario, a downtrend followed by a bullish reversal pattern, followed by confirmation. An entry trigger for a long trade this time. Once again, not a guarantee of profits in the long direction, just an indication of an entry that stacks the odds slightly in your favour. And that's what we're after here, and that's why I love candlesticks. Here's a different scenario though. An uptrend, followed by a continuation pattern, and then confirmation of further move in the long direction. Once again, not a guarantee of profits long, but an indication of potentially higher probability of a long trade. Notice I keep repeating that. It's so important to understand it for you to make that transition from novice to professional trader. No entry trigger provides a guarantee of profits, so you need to actively manage and exit your trades in order to minimize risk, because there is always some degree of probability of the market turning around and striking to take you down and destroy your trading bank. So, a fourth scenario. In this case, we have a downtrend, followed by a continuation pattern, and followed by further confirmation. That's basically our four scenarios. A trend moving either up or down, followed by a reversal or continuation pattern, followed by confirmation. Candlestick patterns provide no identifiable edge that I'm aware of or have ever read about in this scenario. A continuation pattern appearing within a sideways trend or consolidation pattern or trading range, whatever you want to call it. This can lead to an uptrend, a sideways trend or a downtrend. Who knows and who cares? We don't even try to trade it. If you see a continuation pattern in this situation, that is a sideways trend, then ignore it. There's plenty more trades coming later. And likewise for a reversal pattern displaying within a sideways trending market. Price movement beyond that is once again an unknown quantity, perhaps up, perhaps sideways, and perhaps down. So for reversal patterns or continuation patterns in sideways trends, do not trade them. Couple of examples here in the 5-minute mini Dow chart, and I hope you can see this on the small YouTube videos. We have an uptrend, followed by a shooting star bearish reversal pattern, followed by confirmation of the change of trend by price breaking below the low of the shooting star pattern. And what does that lead to? A bit of a slow descent initially, but then price accelerating into a very nice and very profitable downtrend. So an uptrend followed by a bearish reversal pattern, in this case a shooting star, followed by confirmation leading to a low risk, high probability trade in the short direction. Second example, a downtrend followed by a bullish reversal pattern being a morning star, and confirmation through trading above that morning star pattern, leading to a great trade long. A little choppy in this case initially, they're never perfect, with a retest close to the lows, but unable to reach those lows and displaying a rejection of prices at that low point before rapidly rising in the long direction. Before we wrap it up though, let's quickly discuss a very important point. What do we mean by reversal? In candlestick analysis, when the gurus discuss reversals, they don't necessarily mean price will reverse, as in the example here. Okay, it doesn't have to be just a full reversal to the downtrend. A simple halting of the uptrend is sufficient. So a bearish reversal pattern, it could turn the price, it could simply halt that previous uptrend. That is still a valid bearish reversal pattern. And for a downtrend that hits a bullish reversal pattern, we expect it will more likely develop once again into either a sideways trend or an uptrend. Okay? In other words, although it's called a reversal pattern, be aware that price won't necessarily reverse. Watch simply for a change in trend. And one other important point before we wrap it up for this video. What is the time frame of influence for a candlestick pattern? Seriously, do you expect a bullish reversal pattern at the bottom of a downtrend on a 5-minute chart to then signal the start of a decade-long bull market? Well, it might, but it's not likely. It's a pretty safe bet that you're going to go broke if you're trying to catch that signal. Typically, as a professional trader, you need to expect that candlestick patterns will influence the market over a very short time frame only. We're talking anywhere from just one candle to maybe a half dozen candles. Anything beyond that is a bonus. Of course, that is heaps of opportunity to find a profit. And more important points, I promise this is the last. Remember, candlestick patterns are not the holy grail. They are just a tool, not a complete system. That's what I mean when I say you can't just blindly take every signal. Ensure first that they occur within a trend. And more than that, find out where they occur within the bigger picture market structure. If you don't know what that means, then check out my Strategy 1 and 2 videos on my website homepage at www.yourtradingcoach.com. Finally, candlestick patterns are subjective. We're going to look at examples in coming videos. Understand though that in reality, not all patterns will look exactly like the textbook examples. This is where you really need to be able to read the sentiment of price movement, regardless of what it looks like, as we discussed in previous videos. So learn to read the sentiment rather than just blindly look for the patterns as they appear in the textbook and the coming videos. So coming up in the next video, we'll start with the sexy stuff, the candlestick patterns, so hang in there, I'll see you again real soon. I'm Lance Beggs from www.yourtradingcoach.com, wishing you happy candlestick trading.